Namaste to all of you. Very, very warm welcome. Thank you so much for taking time out. Today, we have a special member of Ambit Asset Management family with us, Siddharth Bothra. Siddharth Bothra is the gentleman who's gonna be on the steering wheel from here on for Ambit Coffee Can. A guy with a strong pedigree, a guy who believes in long-term investing, long-term investments, and ensuring that your money, your wealth compounds and compounds at a significant, rapid pace with limited amount of risk. That's what Siddharth Bothra has stood for in the past, and he continues to be that way. Siddharth Bothra is a known name in the investment management of the country, and going forward, he will figure out businesses which are mispriced yet having significant moats irrespective of the market cap, and which can play the journey of compounding. Today, we are going to hear from Siddharth about his journey, about the thought process which he's going to bring to Ambit Coffee Can, and all the questions and doubts, my friends, you have about Coffee Can, he'll be answering. My request to all of you, please do not stop yourself. Post all your questions. Post all your questions in the chat. Post all your questions in the chat, and we will answer them. Siddharth, a very, very warm welcome, and thank you for addressing our esteemed investors, our esteemed partners, and people at large. Let me begin by asking you something personal, something about you. How did you got into this investment management? What propelled you to start doing investing? And tell us about your investment journey so far.
Sure, Siddharth. Thanks for having me here, and I'm delighted to be able to, address all the participants here. So I'm from Calcutta, and my family was always in business, and many of them were very active in the equity markets. So equity investing and stock market for us, came very early in life. I remember my first investments, my first dabble in the market would have been even as early as class 8 or class 9. So I did my schooling and my college in Calcutta, and I worked. There were very few research houses. I was very fortunate to be able to find people who kind of helped me take up research or be an analyst in a city where there were hardly 2 or 3 research houses. So I worked for almost 4 to 5 years in Calcutta, wherein I worked in organizations like United Credit Research, then at BCK, and in 2003 and 4 is when I moved to Bombay. My initial journey was as a analyst, and in my last organization, I was almost like I worked there for almost like 18 to 19 years, and that was at Motilal Oswal Financial Services. My 9 years to 10 years, I was there as an analyst, where I looked at various sectors. And subsequently, in 2013, when the firm was looking at launching the active mutual funds, is when I moved to AMC, and I was fortunate to be part of the initial team which launched the maiden mutual fund there, which was Motilal Oswal Focus 25 that time. And since then, being involved to taking up as a fund manager for the same. I had a journey of 10 years managing that fund as well as a hybrid fund. And in my journey of 10 years at Motilal Oswal AMC, I saw our overall AUM go from somewhere around 1,500 crores to, at the time of me moving out, close to around 50,000 crore. And I had the opportunity to manage different kind of fund products from large cap to mid cap to flexi cap and even hybrid. Uh, at the peak, I was managing close to around 16,000 crore. And I got a very rich experience there where our investment philosophy was of a buy and hold and long term oriented investing. And that's what kind of is becomes the second nature for us. So I believe that investing is all about buying quality companies and benefiting from letting it compound over. So the magic of investing is compounding. And the way I look to do it is, buy quality companies available at, fair prices and run by great management, which has been the time-tested thing for such kind of investments. And when I look at the Ambit coffee can portfolio, which as Siddharth mentioned is what I'm managing here. What I'm really excited about is that it gives me an opportunity to really do what I really enjoy, and something which I have kind of practiced in the last 10 years.
Thanks, Siddharth. A very interesting saying by Charlie Munger. So Charlie Munger, the gentleman who just about lived a century, a legend in itself, and he said, a majority of life's errors are caused by forgetting what one is really trying to do. And kudos to you, Siddharth, that as luck will say, or providence, you kept on moving from one organization to another, not too many, but you found the path of long-term investing, you found the path of compounding, you found the path of picking up businesses which can turn into gold over years and years. Now, since you are at the steering wheel, you are the Sarathi for Ambit Coffee Can from here on. How do you see Ambit Coffee Can? What's your definition of Ambit Coffee Can?
So, thanks, Siddharth. When we look at the core essence of Ambit Coffee Can portfolio, it's about buying. It's addressed to investors who are looking for absolute returns by investing for long term in quality businesses that can compound capital at high rates over a long period of time. To my mind, finding such businesses is extremely rare, and the real hurdle for such kind of companies is the competition, the innovation, and the deflationary impact of on the prices side. The essence of coffee can remains the same what was in the past and even when I manage, which is to look for superior performance, which comes from compounding capital at high rates of return over long periods of time. And we are looking for companies which have those kind of characteristics, and some pattern which are common in the past, where companies which have successfully done it, and bring in our advantage on the behavioral side, bring in our analytical advantage, and look at how we can capture a select set of 10-15 such companies, and then let the magic of compounding happen.
Thanks. So the true self of Coffee Can will remain. However, we will keep seeing that businesses which have humongous amount of pricing power is going to be the forte, and that's what Siddharth is going to bring to all of you. My next question to you, Siddharth, is but before that, let me quote Charlie Munger again. I love that man and his investment thinking, and he says, it's amazing to see how intelligent it is just to spend some time sitting and thinking. And both Charlie Munger and his partner, Warren Buffett, does a lot of thinking, which is very, very uncommon, especially in the United States. I can't talk about India. A lot of people are way too active. That's what Charlie Munger says. Coming back to it, generally people have this notion that Coffee Can is lazy investing. People have this perception that Coffee Can is associated with the past, with the quant, but in this dynamic environment where disruption is happening at a very, very rapid pace, adaptability, innovation, and behavior of businesses matter. So there are two schools of thoughts. One is Charlie Munger, where he says that be inactive and find the opportunities and grab them and put a lot of money in there. Take concentrated bets. And then we have this disruption. So how do you commingle? How do you make a conjoined statement which creates value for the investors? Siddharth.
Sure, Siddharth, it's an interesting question. So, the way I would answer it is that, when you're looking at businesses which will benefit from compounding, I have, through my practice over the last 10 years, realized that, there's one particular aspect which works for me and, which I feel is one of the best representation for companies like this, and which is pricing power. By pricing power, what I mean is either a company is able to price their products at a good premium to their rivals and the overall industry, or they have a significant cost advantage. And in extreme cases, in rare cases, we find some companies which have both these advantages. And finding such companies, what it does is that as you mentioned, we are in a very dynamic world where there's disruption happening all the time. There is innovation, there's a threat from competition all the time. But when you find companies which are doing that, that is where you feel where you find a group of companies which are exhibiting this kind of a pricing pressure. What happens is you are finding companies which are able to address issues on inflation, address issues on competition. So they typically are very, very dominant in the industry. The kind of moats they have built are able to kind of keep the competitors away. At the same time, their business model is so robust that it's able to kind of, or either the business models are so simple, the business is so simple that the innovation or some of these disruptions impact them less. Just to summarize, I think one of the ways we try to do it is number one, try and find companies which have pricing power. So, a lot of these things that, find companies with dominance, find companies which are able to meet the key threats being competition, key threats being innovation, and the deflationary impact on prices. All these get addressed when you find companies which have a proven track record or who are exhibiting signs of pricing power. And other than that, I think what you need to do is have an open mind. And I believe one of the other ways is always be in watch for what you would call as forward coffee can companies, or companies which on a future basis would become what the truly famous companies today, or the top examples of coffee can companies are today. Like for us today, if the best example of long-term investing, say assuming is say a Titan or Nestle, or similarly in some financial segments like say in the past HDFC Bank, then you always have these characteristics which are visible even for companies which are still not having that kind of legacy, but are clearly demonstrating and exhibiting those signs. So a combination of having a legacy companies which can kind of negate the pressures we see, and some companies where we see early signs, and the moment we see demonstration of this, a mixture of this should be able to kind of address your concerns.
Fantastic. So what Siddharth said, that don't look at only the past, don't look at the cons, don't just look at the history or the magic behind the businesses which have already become big, but look at the businesses which can be the future Ambit coffee can companies, future coffee can companies. Very, very rightly put. And that again reminds me of a very interesting quote from Charlie Munger, and it's a short one, and it says, people calculate too much, think too little. I think the fund manager here has to do a lot of thinking, just looking at the computing or the numbers, which anyways any algo or any computer can do for you. So thanks, Siddharth, for bringing this very novel, very interesting perspective. My next question is again, and this has been the stereotype which we have been listening, that coffee can companies are expensive. And in calendar 22, we saw that interest rates rose unprecedented, both in quantum and both in velocity. Quantum jump and the speed at which they rose. Thanks to that, The peak compression happened in the coffee can businesses. Earnings sustained, but yet there was a little bit of price destruction, and that's what hurt the coffee can returns to a certain extent. So out of 7 years of coffee can history, calendar 22 was a tough year. Was a tough year. Now, what do you see calendar 24 look like when you're going to see an interest rate declining, macro headwinds which have hit in 23, they may subside, stable government, things becoming normal, bottom of the pyramid spending, everything looks good. What do you think about calendar 24 from Ambit Coffee Can present and the future perspective?
Thanks, Siddharth, for the question. So, as I hear your question, there are two parts to it. In the first part, you're talking about why, the sharp surge in interest rates led to maybe the underperformance that companies of high quality or, Ambit Coffee Can saw somewhere in 22, 21 calendar year. And the second question is, how do I see things going forward? So, with regard to, the question on how we address some of those issues is that if you look at what happened in 21, 22, for a long period of time, we were seeing a very market being very narrow, where most of the long-term investing or most of the chase stocks were more in one or two particular sectors, whether it be consumer discretionary, and the economy side of the market was largely being ignored. So one of the learnings from that period definitely is that as a portfolio, we need to be not like very lopsided. We need to have some kind of a balanced portfolio where we are not ignoring the future sectors which would be in limelight over the next 2 3 years 4 years. And the best part is that you find CCP companies, you find coffee can kind of characteristic companies in various sectors. It's not that you only find it in one particular sector and all. So one way of addressing it would be that. The second thing, which worked even in that time was that if you really found companies where growth was still there or where pricing power was being exhibited, then despite all the headwinds that you talked about, the companies not only did operationally well, even on a stock market, they continue to do well. Good examples here would be, say again, something like Titan, something like Nestle. You look at examples like Ambit and so on. So a combination of finding companies where you have more visibility on the growth, where pricing power is significant, and having a little bit of a diversified sector. So you find coffee can characteristic kind of companies in different sectors, and that would be one way to address that. And the second part of the question as to how you see 2024 and how do you see going forward. So one thing that we have seen in the last 2 3 years is that we have seen a period post-COVID, which has been a period of risk on investing, a period where high beta companies have done well. Also a period where economy, after having been beaten down sharply, was on a reversal. So the growth rates in some of the completely ignored segments of the economy did very well. So that's what we see reflected in the markets where many of these sectors which fall in, say, a small cap or mid cap, they did significantly better. And when we look ahead, I think the divergence between the estimates of earnings growth for, say, large cap versus mid and small, so that divergence is coming down sharply. Many of the large cap companies have seen significant valuation corrections, and the growth, some of the macro related issues which were beating down growth is also reversing. Interest rates being one of them, raw material prices coming down, which led to margin expansion in the last year. So when we look forward, I think you will see some kind of a reversal in the particular pockets of market which have seen higher underperformance in the last 2 3 years. And I feel that Ambit Coffee Can is positioned in a very enviable manner, in the sense that not only do we have a large cap bias, also the orientation of the Ambit Coffee Can portfolio, which is more towards quality, more towards sustainable competitive advantage companies. These companies, to my mind, over the next 2 3 years will see better performance than from many of the sectors and companies in sectors which are not known to historically create wealth. So while a sudden, sharp reversal in economic activity leads to some sectors which were, hibernation for long periods of time coming back, but history teaches us that many of these sectors, because the nature of the industry, have not created sustainable wealth. The reasons being that they don't really have competitive moats. The moment they have 1 or 2 years of making good money, the competition comes in hordes, and because they don't have the kind of moats which you see in many of the coffee can type companies, the profitability gets eaten out, and there is capacity overhang. There are many things which change very suddenly, and often investors are not able to catch the inflection point. So case in point being, say, if you look at the chemical industry, it had a period of 1 2 years where it did very well. Some stocks, even preceded that period. But in many of the segments, we saw sharp correction. And that's the nature of industry that, when you make money, a lot of capital kind of chases it. And because there is not significant competitive advantage or moats that these businesses have, we have seen sharp reversal in many of these companies. I feel that when we look at 2 3 years ahead, I think one thing is very clear. I see more opportunity in large caps because of the fact that valuations are beaten down. And while it's true that the small and mid caps have done better, one question that you need to ask yourself is that in the large cap companies, has their dominance come down? Has their market shares declined? Or the secular shift from unorganized to organized, that has that reduced? Or some of these key questions to ask is that is this company any less competitive? The competitive advantage, has it reduced, or they've been increasing their moats? So if the answer for companies where you think the answer to many of these questions is yes, then it's more a momentum related issue where a particular bucket of investing, or particular style of investing is being chased, and it can happen anytime that these companies, despite the underperformance, can come back sharply. So just to summarize, I feel large caps over 2 3 years should do better. I feel that quality companies which have sustainable competitive advantage, which have high moats, will be able to sustain the performance, and hence over a 3 year 4 year period give you better returns, because some of the other sectors don't have the competitive advantage to be able to sustain good performance over a longish period of time. So that's how I would think about it.
So thanks Siddharth for it. So what Siddharth is simply saying, ladies and gentlemen, here is that the businesses which have done extremely well, or the sectors or the industries which have done extremely well in last couple of years, may or may not have significant past track history. They may have done well on the backing of a certain event, on a certain spending which has come from the government or elsewhere. Do they have a track history of compounding consistently for longer periods of time? May or may not. Number two, as he rightly said, that large caps are reasonably valued at the moment, and hence they present a extremely good opportunity. Number three is coffee can moats. Are they reducing? What he spoke about is, are the coffee can businesses having margin pressures, or their competitive advantage, or their defensibility, or their market share, or the size of the industry, is it shrinking in any manner? The answer is no. Then why doubt? Then why doubt?
So that I'll just add one
yes,
more point
please.
to it is that from an investment perspective, we look for companies which have, as I mentioned, the characteristics of already proven business models, which we call coffee can companies. And these are companies which we feel can sustain their competitive advantage, can compound the capital at high rates over a long period of time. So we are to that extent market cap agnostic. When we look at the Ambit coffee can portfolio, there's no market cap restrictions. So we don't really look macro, or we don't try to take macro calls on this will do better or something. It was more in response to the question. And if we find pockets of excellence or new sectors which were not there earlier, and if they happen to be small or they happen to lie in the small and mid, we are in a position to leverage on that. We are in a position to include it in our portfolio. And as such, while the street talk often gets more lopsided between market cap, which will do well. We are not in the business of forecasting that. We are in the business of finding excellent businesses where we think the chances of high compounding is really high. And even if we find them in various segments, we will buy that. So, to that extent, while we have a view that when I look at the fundamentals, it seems that large caps appear more attractive. Even if we find them in similar characteristics of companies available at valuations which we feel are fair in small and mid, we are not adverse to adding that. We're not suggesting that quality companies with CCP like traits will do badly just because they happen to be in small or mid versus a large cap. So it's a fine. I just wanted to not
No,
any confusion with regard.
so thanks for clarifying that we are market cap and sector agnostic. Whatever fits into the history and whatever fits into the future will be bought in coffee can, because what is consistent in coffee can is the earnings growth of the future. That's what we are trying to chase in coffee can. Thanks, Siddharth, for bringing this great equilibrium or balance point in the conversation. My next question to you is, FI ownership has been reducing in the country. We are seeing that now Bharat is the market cap has exceeded $4.1 trillion, and we are constantly seeing that the domestic flows have been robust. FI holdings have been reducing. Now it is closer to 16.5%. The FI flows also have been sporadic. There have been macro events which have forced FIs to come in, get out. We saw wars. We saw the Israel-Hamas conflict. We saw changing commentary from the Fed, and that's what is propelling the FIs to come in, get out constantly. And these are the businesses which coffee can businesses essentially represent Bharat, the growth in Bharat, the consumerism in Bharat, the urbanization in Bharat, the premiumization in Bharat, the income growth in Bharat. And hence, FIs love these companies. Now with the flows coming in and out, how do you sustain the stock price, and how do you generate returns? So that's the question I have. It's a tricky one, but you are the man.
Yeah, no, so I hear you that, what your question emanates from is the fact that in the last 2, 3 years, we have seen that FIs have been generally sellers, and, sectors where they had dominant ownership, or, where they had majority ownership, those sectors have not done so well. And the recent money, the domestic money that we have seen has more flowed into small cap or, segments where the FI holdings not been well, and in these segments have done better. So to answer it is like, as investors, we have to look for value. We have to look where the price and the intrinsic value, difference is very high. And, these are technical aspects which get sorted out. To just give you an example, if you were to ask 2, 3 years back that, in midst of COVID, in midst of all this, even when FIs were selling, how would markets do well? Who would buy? At that time, to kind of suggest that we would see the kind of the flows that we are seeing today in domestic, very few people would have believed it. But if you had the economic revival, if you had earnings growth coming in, and if you had some segments where there was value, there will always be buyer. So I believe that one of the things where the near term flows get dictated by is the momentum. So, momentum kind of decides a lot of this. Like if you had 1 or 2 years of some particular segment or some sectors doing very well, then you see that, there is a large part of markets which kind of try and follow that. And the flows that we are seeing, which is more concentrated in one market or one different kind of things, is a result of how markets have done in the last maybe 2 years, 3 years. Having said that, no trend remains forever, and the markets are very cyclical. So these can change anytime. The only way we can address it is by, looking at, where we find value and not getting tempted by, trying to chase fads or trying to chase the momentum. While I have nothing against momentum investing, that's not, what we practice here. So to that extent, I feel that, as I was mentioning, there's more value today I find in quality companies, more value I find in large cap. And there's nothing written. It's not that FIs will only buy this, or domestic money. The investors have said that look, we will only buy a particular class of market cap. They would buy where they think their prospective returns would be better. So if tomorrow, the prospective returns looks better, if the momentum changes, what is it to say that the flows that you're seeing from retail and small, or the variance that you're seeing cannot come back. Having said that, the FIs flows also at some point or the other will come in, because when you look at it on a global basis, if there is a country, or if there is a one particular market which is doing very well, it's difficult to ignore. Then there are MSI and MSCI indexes where you have weightages. There's changes happening there. Some countries are coming in, some are going out, some are getting out of favor. So these are technical aspects which you can't predict, but you can be very very sure that if there is value, if investment case is there, then money will come in. It's more an outcome rather than a result. It's not that because they come, something does better. It's because there's value, because these companies are worthy of the kind of valuations they should get, that investors come in. And I would believe that if you have 1-2 quarters where large caps do better, mid caps do better, there is nothing to say that you will have a complete reversal of the domestic money also, because I have never known any domestic investor say that look, I'll only buy X or Y. They often have a more narrow, shorter term focus, which has been in the past. Even retail investors and all are evolving because they are being advised by more professional people and so on. So this we already seeing. There's so many PMSs I hear, or I've read, who have stopped taking inflows. Many of the advisors and all I have met recently, they mentioned how they are pushing the investors to move to different classes. So these are some things which self-correct. We remain focused on where we find value, and as I mentioned, the CCP we think is very enviably positioned, because not only does it have a large cap bias, also the kind of companies we have there seem to be expanding their competitive mode. These are companies where over the last 2-3 years the advantages have only increased, and sooner or later they will start seeing investors also chasing them.
Very, very, very well put. So this again reminds me of a quote from Charlie Munger. So he says, acquire worldly wisdom and adjust yourself and adjust your behavior accordingly. If your new behavior gives you a little temporary unpopularity with your peers, then to hell with them. So it doesn't matter what is working today, the philosophy, the valuations, the opportunity lies in coffee can companies with modes, which have defensible modes, as Siddhartha put it, as well as he rightly articulated, that it does not matter whether it is a large cap, mid cap, small cap. The question is, these are the businesses which are priced at the right place and can compound significantly higher than the marketplace in next few years time frame, and hence you should own them. Thanks. My last question to you is very very fundamental. So Ambit Coffee Can has a philosophy, has a framework. What do you think is your thought process of compounding? What is your framework of compounding? If you can elaborate what you have always been believing, because there is something which we cannot compromise in, the core. So that's what my question to you is. So what's that core?
So Siddharth, as I was mentioning, I think if I were to condense some of the things that I look for in investing, as I mentioned, it would be companies with good pricing power. So companies with pricing power need compounding to happen, and one of the key things here which is required is, like, if you look at three sources of advantage that is available to investors, whether it's information advantage, analytical advantage, the behavioral advantage. Then I think the key thing is if you look at this the chart, the table we have in front of you, To compound money on a long-term basis, what you need is to be invested in it for long term, have a long-term mindset, and I believe that the long-term mindset is something which can only happen if you have that kind of a behavioral advantage, and that's what we bring to the table, and so it would be a mixture of buying pricing companies, and I was referring to this slide here. I try and look at companies from both the quantitative framework angle, and I give much higher weightage to the qualitative framework angle. And when I find companies which are meeting both the quantitative framework as well as the qualitative frameworks, and seems to suggest that they have the characteristics to be able to compound on a long-term basis, those are the companies I identify. So in essence, in the core sense, I think the core philosophy of Ambit coffee can is timeless. Like it's the 101 kind of a thing, that is buy great businesses, buy businesses with great management, and then let the sitting make you money. Like as Munger says that wealth is made more by sitting rather than by buying and selling. That's what. So I think the core essence, nothing changes. Maybe every investor, I mean, an individual fund manager brings in own perspective on how he sees it. So this is what I was trying to refer to. For me, things come more from trying to identify companies which over the next 2 3 years will see, which will become, stronger, or where we see forward, quality emerge, or, companies which are increasing their pricing power, increasing their moats. So I pay more weightages there. And my broader framework is to look for companies with pricing power, then look for companies where I see moats increasing, I see pricing power increasing, and then do what you need to do with these companies, which is use the behavioral advantage of not getting moved by what's happening in the short term, and taking a long term view and hold them for a long period of time. So to summarize, not nothing major changes, and it's just that I bring in slightly different perspective on how you identify such company.
Great.